Hey guys, Rafi here from the Endgame Investor. And we're going to talk about two things today. First of all, we have a flood of treasuries that are coming in on the market. It's about 500 billion by June 13th. I think $250 billion have already been issued. Another 250 billion are coming the next week or so. We'll go through the exact numbers and we'll discuss what is going to happen, who is going to buy these T-bills. There are two possibilities. Either they will come from existing deposits in the banking system, and that will cause a liquidity drain, or they will come from reverse repos or money markets. They're really the same thing these days, and it will cause a liquidity flood as money is taken out of the reverse repo facility and put back into the money supply. So they're two very different things, and what we can track to figure out what is going to happen here. And also a philosophical point, where does money go when it dies? What happens to all the deposits? What does it mean when deposits fall? Where are they going? Who is pushing them away? It's all very sad. And the answer is a big black hole called the Federal Reserve, and we'll illustrate the point as to why the system is inherently exponential and unsustainable and requires increasing amounts of inflation until the system explodes, which it is on the verge of doing, and I will show you how. So first of all, we're going to start with a few nice little articles from our favorite mainstream media sources with the funny names. First of all, we have this Bloomberg article, $1 trillion Treasury vacuum coming for Wall Street rally. We've talked about this in previous videos. JP Morgan Chase & Co. strategist Nikolaos Panagurtsoglou estimates a flood of treasuries will compound the effect of quantitative tightening on stocks and bonds. This is a very big liquidity drain, says Panagurtsoglou.
My blue barb has broken.
We have rarely seen something like that. It's only in severe crashes like the Lehman crisis where you see something like that contraction. Panagurtsoglou thinks that this is going to be a liquidity drain. But then a guy named Wigglesworth counters and says, well, maybe not. Channeling Louis XV with the title Après debt ceiling deal, le terrible deluge. Gird yourselves. You see here, this is Robin Wigglesworth. I don't make up these names. Somebody else does.
It's frickin' freezing in here, Mr. Bigglesworth.
Here, Wigglesworth gives us some useful context. He says, a bit of context may be useful here. Indeed, it can be. As the Fed tightened monetary policy to combat inflation by rapidly raising the Fed funds rate, we have seen a steady outflow of funds from bank deposits into money market funds, which picked up dramatically after the regional banking problems that began in March. The debt ceiling concerns have added to the cash parked at money market funds, which reached an unprecedented $5.81 trillion as of May 25th. Money market funds, in turn, have deposited their cash at the Federal Reserve using reverse repo purchase agreements, earning the reverse repo rate. What is the reverse repo rate? That is 5.15%. We'll get to that chart in a second. This is actually not Wigglesworth. This is him quoting somebody else. Who is he quoting here? He's quoting Vishwanath Tiripatur. Globalization. So Tiripatur says, while MMFs are the natural buyers of the deluge of T-bills to come, the yields need to be above the reverse repo rate for them to buy them. This means higher funding costs in the short-term money markets, which in turn would add to liquidity challenges for banks. So basically what Wigglesworth is saying here through Trinapatur quoting is that one of two things can happen. Either banks will fund this treasury issuance with deposits and deposits will shrink, or the money will come from reverse repos that are now paying 5.15% to money market funds, and it will be liquidity neutral or even liquidity positive if that money is going out of reverse repos into the money system, into the money supply. So what is going to happen? Well, we can figure that out by tracking two things. First, the amount of reverse repos in the system, and second, the amount of deposits in the system, and third, we can track the likelihood of money market funds moving over from reverse repos to treasury bills by looking at the interest rates that are available for both, the arbitrage between them. If the interest rate is significantly higher in treasury bills, then yeah, money will probably move out of reverse repos into treasury bills, back into the money supply as the treasury's general account is drawn down after this raise. So let's see how much money they've raised in the past 2 days, how much money they will raise by the 13th of June, and where this money is coming from. We know that reverse repos pay 5.15%. These are the Treasury bill auctions that were completed right after the debt ceiling bill passed. We have here a 29-day bill for 5.05%. That's below the reverse repo rate. So that's not going to come from reverse repos. We have here a median rate of 5.165%. That's just above by 1.5 basis points the rate for reverse repos. I don't know if that will draw money out. And we have here 5.18%. Not sure. Doesn't look as like such a big arbitration. It takes, some effort and some regulatory scrutiny hurdles maybe, and just some annoying whatever to move money out of one thing and into another thing, because you got to change all these, releases, whatever it requires. I don't know. And you have here a 119 bill for 5.3%, a low rate of 5.15%. It's still not significantly above reverse repo rates. And here 5.2% for a 182-day bill. I think that's a 6-month bill. And I think the total on all these auctions, something is $250 billion. Now, upcoming, we have this tab. If we click on upcoming auctions, we have all these 17-week, 4-week, 8-week, 13-week, 26-week, and 52-week bills, right? All auctioning from June 7th, which is tomorrow. I'm recording this on June 6th, until June 13th. So 1 week. It's probably going to be about the same amount as the 5 auctions that were just finished, about 250 billion. So 250 billion plus 250 billion is about 500 billion. That's about $500 billion being dumped onto the market worth of treasuries in about a week. Here's the reverse repo rate. We see it's 5.15%. This is a static administrative rate. The Fed just decides it to pay it directly, and they decide what the interest rate is. It's not based on any market forces. Now, thankfully, we have a daily chart for reverse repos. This is the money market fund money, basically dollars that couldn't be absorbed into the banking system during the lockdown printing, so they are waiting outside of it, earning interest from the Federal Reserve. And if you wonder why the Federal Reserve is running a consistent loss, it is because of this. They pay interest on these extra reserves, and they pay that out of nothing, and it is totally unbacked dollars, not even backed by any kind of asset at all. This is the kind of stuff that hyperinflation is made of. So if this chart starts to fall, if this number starts to fall from, it's now at 2.131 trillion, if it starts to fall by hundreds of billions of dollars, then we'll know that money's coming out of reverse repos and going into the Treasury's general account, and they will use it to pay off whatever bills they have to pay, and the money will go back into the money supply. Or we can also track this chart. This is deposits at large domestically chartered commercial banks. We see here we are at a high of 11.55 trillion on April 13th, 2022. We are now at 10.633 trillion and still falling as of May 24th. If this number falls significantly, then we have deposits from banks being used to buy all these treasury bills, and that will bring the money supply down further. Now, I wanted to go into a philosophical point, or a point of monetary analysis, economics, and that is, where does the money go? Where do the deposits go when they fall? How can you have deposits of 11.55 trillion, then 10.66 trillion? Where are the missing deposits? Where did they go? Why aren't they here? Why don't they exist anymore? And the answer is, you have to understand how the monetary system works in a very basic sense. You have a Federal Reserve, a central bank, that buys debt, its asset on its balance sheet, and issues dollars. Let's say that it buys a bond for $100, maturing in a year at 10% interest. The very first time that the Federal Reserve did this in its founding in 1913, whatever that bond was, they bring $100 into existence, and on that bond, $110 is owed eventually back to them. The problem is, there aren't $110 in existence, right? There's only 100. So what does the Fed do to make sure that that asset can be paid off and the money retired? Well, it simply buys another bond. Let's say another $100 bond for a 1-year maturity, 10% interest, and it issues $100 for this bond. In exchange for this bond, now there are $200 in the money supply, in the monetary system, and the first bond owed $110 to the Fed to be taken out of existence can be paid back. But after that is paid back, what do you have? You have $90 left, $200 money supply minus 110 paid back to the Fed. $90 left to pay back a $110 debt when the next bond comes due. So instead of a $10 deficit, you have a $20 deficit, and the situation gets worse. So what does the Fed do? It buys another bond and another bond and another bond. And every time the deficit gets wider and wider as to what is owed to the Fed versus the amount of dollars in existence, and you have a dollar squeeze. So what can the Fed do to lengthen the runway? Well, it can lower interest rates, because when you lower interest rates, you have to pay more money for the bond. The Fed pays more dollars into the economy in exchange for that bond, and they get paid less interest back. So the deficit between how much is owed back to the Fed and how much dollars are in existence shrinks by lowering interest rates. This is why the Fed has to lower interest rates periodically to stay on the curve. The other thing they can do is they can lengthen maturities. If instead of buying a one-year bond with a one-year maturity, they buy, let's say, a 5-year or a 10-year bond, then 5 years and 10 years, only then does the principal have to be repaid. And the whole sham, the whole farce, the whole circle, the whole hamster wheel can continue on and on and on. But eventually it has to stop. It will stop when the debt on its balance sheet, the mortgage debt and the Treasury debt, well, primarily the mortgage debt will default first. When those assets start defaulting, that is when the money supply really starts to plummet and deflation happens. Now, if the Fed allows that deflation to continue happening, the defaults will filter all the way through the system, and all of the assets on its balance sheet will default eventually, because the dollars that are needed to pay them will start slipping out of existence faster and faster and faster. And eventually, if this process is allowed to complete, then the entire planet will deflate down to a $35 an ounce gold, because that is the remaining asset on its balance sheet after all the paper has defaulted, which it will default as the deflation continues. And then in the rest of the world, which is based on the dollar, all of their assets of those central banks will also default, and you'll have a global deflation all the way down to a $35 an ounce gold price, where we were before the gold window was closed, or somewhere around there. Not exactly, but you get the point. So instead of doing that, the Fed will simply have to buy more and more and more bonds and issue more and more and more money to maintain the solvency of its balance sheet. At a certain point, the exponential curve that feeds this system goes vertical, and that is the point of hyperinflation when the currency is dumped. At a certain point, the dollar is going to be squeezed enough that there's going to be a big default somewhere, and the Fed is going to have to push its balance sheet back up, which is exactly what it did during the Bank Term Funding Program when the regional banking crisis hit. That's only the beginning. The next defaults are on their way, and when they happen, the balance sheet of the Fed is going to have to go higher and higher with longer and longer maturities and lower interest rates, and that is going to cause a dump of the dollar in the streets and the end of the monetary system as we know it. The only question is, what angle are we at on the exponential curve? This is Ralphie of the Endgame Investor. If you're interested in checking out the Endgame Investor, where I track this stuff in detail on a nearly daily basis with a weekend report, then click on the link in the description below and get a 2-week free trial, or become my patron on Patreon, where we talk about biblical concepts of money and economics. And this week we're doing why nervous breakdowns are necessary. No matter how close to God one is, there are always nervous breakdowns, and there's always rebuilding after those happen, even with monetary systems and societies and everything else that we've known in human existence.
So does anybody really wonder why anybody is hanging on to sanity by the atoms on the tips of their fingernails while life dirty dances on their digits? And is it really any wonder that I seem deranged?
See you guys next week.